Hi, I'm Grady Kerr, and the case I chose is Rogers Chocolates. A little history about Rogers Chocolates. They were founded by Charles Candy Rogers in 1885. It was the first chocolate business in British Columbia, the second oldest business in British Columbia. They've had 5 separate owners in over a century of being a business, and their sales have grown by over 900%. The key problems / issues for Rogers include not enough customers. The ones they do have are extremely loyal, but they're getting elderly, and their failure to expand. Multiple firms have grown around them, i.e. Nestle and Godiva, and that's happened so long ago that now they're afraid to ruin their reputation. External analysis. After completing the pestle model, came to my conclusion that Rogers does not have any political pressures. Economic factors. Growth rate of the market is 20% annually. Employment levels are dropping. Rogers, as of now, has 110 employees, going from board of directors all the way down to factory workers. And price stability. The value of product increases as the shipping charges increase. And currently, the currency rate of the US dollar is roughly 1.4 in Canadian. Sociocultural factors. Consumers have become more health conscious. Luckily, the technological factors of Rogers, they're incorporating a new line of 100% organic chocolate. Other than that, Rogers hasn't changed since its start in the 1800s. Ecological factors include no real ecological factors that go into the making of chocolate. Legal factors. Firms and the competitors are trying to redefine the term chocolate under US FDA guidelines so they can produce cheaper chocolate. And human rights activists are attacking child labor production of cocoa beans. Porter's forces, the power of buyers, very loyal customer base, threat of substitutes, healthy chocolates, cheaper chocolate, and innovation. Rivalry among existing competitors. Lowering cost drive, value creation below acceptable threshold. Increasing differentiation to raise costs above acceptable threshold. And the focus of competition shifts the price. Internal analysis. Tangible resources. Location in Victoria. It's right next to the Empress Hotel, which is right next to the Empress Hotel, and so it's a great location. The factory is located 8 miles from the head office, and they offer ice cream products. In summertime, they have 2 ice cream stores. Intangible, long-time presence in British Columbia, loyal customers, and a great reputation. Core competencies. They're the oldest chocolate company in British Columbia, most award-winning chocolates in the world. Their weaknesses include their struggle to expand and the willingness of new customers to pay for the product. Competitive advantage. Rogers has a competitive advantage as of their location, their reputation, and their award-winning product. Sustainability. Rogers is sustainable but does not have a sustainable competitive advantage. Business level strategy. Rogers pursues a focused differentiation strategy. They seek to create higher value for its customers by having chocolates in the best chocolates in the industry, the best packaging, and the best customer service. Functional level strategies. Support positioning. Managers coming up with strategic innovations to influence the firm to expand its target market / productivity. Change to have so they have a chance to have a competitive advantage. As far as pursuing the blue ocean strategy, Rogers, at one point when they first started, they did because they were the only chocolate company in the industry. And as of now, they fell into a red ocean due to the fact of all their competitors. Corporate level strategy, they pursue related diversification. They currently earn revenues in 4 major areas: retail, wholesale, online, and Sam's Deli. 50% revenues come from retail stores, 30% from wholesale accounts, 10% from online and mail, and the rest from Sam's Deli. Acquisitions and operations. Rogers bought out Sam's Deli not only for the great sandwiches, but a great location to sell chocolate. The goal was to double or triple the size of the company, except they only operate in Canada, and they gain most of their online and mail orders through tourism. Multi-divisional structure. Rogers has a multi-divisional structure. At the top is the board of directors, underneath the president, followed by 3 VPs in charge of product development, payroll, and sales. The structure is very optimal for Rogers due to many third-generation employees. Firm performance. Growth slowed dramatically since 9/11. Tourism is basically non-existent in British Columbia right now. Returns on equity in 2005 were 22% compared to 2006, which was 15%. Similar decreases in return on assets, profit margin, and gross margin. British Columbia chocolate market demand has dropped significantly. Alternatives and recommendations. If Rogers pursues an online business, it would be very cost efficient for them. Low cost of sales and no intermediaries. Profits have the ability to be exceptional. Cons include the efforts could go unnoticed due to the lack of recognition in other countries. Alternatives and recommendations continued. Rogers could reinvent themselves. Pros include a new brand image, new customers, new target markets, new advertisements. Cons, loyal customers might think Rogers is selling out. The new brand image might not be accepted by customers. And in conclusion, the last recommendation. The Olympics is coming to Vancouver in 2010, and the pros of this would be free advertising, new online customers, new target markets. Cons, lose a few $1,000s worth of chocolates. The plan would be simple. You offer free samples during the Olympics. Chocolate stands are available for tourists and people in the Olympics, and you can print website on the inside of the chocolates so that future customers know what the website is. Thank you for your time.